Antonio Zuniga, Oakshore Capital. He's going to be moderating a panel on buying loans and charged off debt from peer-to-peer marketplaces, regional banks, and other secondary sources. This is an amazing panel that you have today with a great group of friends of mine and business partners here. So, Antonio, I'm going to turn this over to you for a strong close.
All right, thanks so much. So the audio is good. You can still hear me?
I can hear you perfect.
Fantastic. So anyhow, again, many thanks for putting our group, this investor series together. And like you, I'm delighted. It's an awesome panel. I guess thank you all for joining us around the globe. I think right now we're up to about 100 folks. Today's panel is entitled "The Buying Loans and Charge-Off Debt Peer-to-Peer Marketplaces." So with us today, I'm joined by investment professionals across both the buy side and the sell side with expertise and interest in a number of lending asset classes. While we have prepared some questions for you, we hope this will be interactive to address your specific questions you might have out in the audience. So Jeremy and I will be actively monitoring the chat and we'll work your questions in throughout the prepared portion as well as during the final Q&A session. Before I pass it on to my colleagues, I'll give you a quick introduction for myself. As Mike was kind enough to say, my name is Antonio Zuniga. Over the past 20 years, I've been involved across many facets of real estate, private lending, and banking. For the past 5 years, I've been managing director of Oakshore Capital. Oakshore is an investment management firm. We seek absolute return strategies in the consumer receivable space. We buy monthly portfolios of fresh charged-off consumer debt directly from the originating lenders. And we use owner-run third-party collection agencies to capture monthly front-loaded streams of cash flow, which are uncorrelated to the majority of traditional asset classes. Mike, next slide, if you have my mother of all slides. And again. Is there one last one?
Antonio, I apologize. We do not have your mother of all slides, but I will get it.
No worries. I can talk to it. What we like to focus on are portfolios of debt that liquidate much faster than the 5 to 7 years typical for fresh charge-off credit card debt that the largest private and publicly held debt buyers focus on. We like forward flows, and by that I mean that's the monthly purchase, month in, month out, of debt from the same originating lender. We like it for 3 critical reasons. First, it helps us create great diversification in each of our funds over a relatively short acquisition period. Typically 6 months is sufficient to get the diversity we're looking for. Second, it simultaneously keeps cash drag to a minimum and keeps us fully invested throughout the acquisition phase until we close the fund and distributions commence. And then lastly, I feel it really aligns all the stakeholders from the lenders that are selling to the agencies that are collecting on our behalf, to the borrowers that are repaying their debt, and to our investors, both me as the general partner and our limited partners. I think with that, let me stop there. And I'd like to introduce each of my colleagues before we go into the prepared portion. I guess to get started, I think Yanel Devico is next on the list. Yanel, take it away.
Yanel, you have to unmute yourself.
Thank you, Anthony. Thank you, Michael. Thank you for having me today in this great panel. I'm the founder of Crosby Capital, a company that I founded about 10 years ago. We are buying non-performing loans, first, second, and unsecured loans across the nation. And we've been mostly focused on residential loans more than like commercial loans. And we're expanding the business right now. It's a great moment for us to expand the business because of this COVID situation. We're seeing a lot of opportunities.
Thanks for that, Yanel. I guess next, let's hear from Michael Ardisson.
Great. Hey guys, can you hear me okay?
Yep, you're coming in clear.
Excellent. All right. Well, thanks, Michael. Thanks, Antonio, for again inviting me to the panel today. I'm Mike Ardisson. I'm the COO and head of business development at Medalist Partners. We're a $2.4 billion alternative credit manager focused on asset-based private credit, structured credit, and CLOs. Really, the history and the background of our business dates back to Credit Suisse, where our team was running the global specialty finance business and the securitization effort. So we have a lot of experience in lending across a number of different asset classes, ranging from commercial real estate, residential real estate, through specialty assets like aircraft, auto, equipment, consumer loans, receivables factoring, and others. So really what we're trying to do is take advantage of the fact that, as we all know, many of the traditional banks and specialty lenders out there that really used to dominate the market, call it Credit Suisse, like where we were, or places like CIT, GE Capital, who's no longer around. Those places really have become limited through increased regulation, tighter credit standards, shrinking balance sheets, and we're looking to step in and help fill that void. So as it relates to private credit, we're really focused on lending where we're secured by either hard assets or financial assets that are cash flowing and amortizing. We look to those assets and the cash flow to pay us back. It's a fairly specialized part of the private credit market. Certainly think that it's less crowded than your more mainstream areas like middle market, corporate direct lending. But our view is that if you understand the different assets, if you understand the cash flows that are coming off those assets, and then importantly, if you know how to structure these private lending transactions, that we're seeing great opportunities out there, particularly after COVID, where we can earn, call it low double-digit net returns, where we think you have a great amount of downside protection.
All right, thanks a lot, Michael. Bill Douning is with BBVA USA Asset Recovery. You're up.
Good afternoon. I appreciate being included in this panel. BBVA, as most of you know, we're a Sunbelt-based bank holding company based out of Birmingham, effectively managed out of Houston, operating throughout the Southwest. Since 2007, we've been owned by BBVA and previously did business under the name BBVA Compass, but have recently undergone a rebranding to just reflect the name of the Spanish parent. My specific role with BBVA, who I've been with since 2010, is in the workout group. I currently manage the Dallas regional office. Right now, my portfolio and those are the people that work with me run the entire spectrum of distressed assets, whether it's small commercial loans, SBA guaranteed loans, on up to bilateral loans and syndicated facilities. Right now, clearly what's got the group most occupied are loans to exploration and production companies, as well as to, as expected, some of the industries that have been targeted, unfortunately, by the pandemic, hospitality, restaurants, retail, things like that. My career has been, I've been involved in distressed assets and problem loans since the late 80s. For the 15-year period prior to joining BBVA, I was a principal at a group based in Dallas called Treadstone Partners and the Treadstone Group, and we were a buyer of distressed debt, typically C&I debt that was secured by business assets, equipment, and owner-occupied real estate. So my background, like I said, has been in distressed assets virtually since I got out of college.
Excellent. Well, anyway, for our attendees, I hope the introductions give you a sense of the breadth across our panel. I'm excited for the group. Sorry, last but not least, we have Rick Stone with Palm Beach Investment Research Group.
Yes.
Rick, there he is. Thank you.
Sorry. So I run a family office of my own, Stone Family Office, and then I also run PBIRG, Palm Beach Investment Research Group, which is a group of 35 family offices who meet, not physically anymore, but previously physically, twice a month to vet investment ideas across the investment spectrum, anything from basic hedge funds and long short equity to one-off biotech deals. We've had a lot of investment in middle market lending in the past few years. We're a little bit moving away from that, but that was a sweet spot for us for quite a while. And we've done quite a bit of non-performing loan investing. So I'm sort of on the buy side and everyone else is kind of on the sell side. But we're from the family office perspective.
Excellent. Thank you so much for that, Rick. So I guess let's just jump right into the first part of the prepared section. I want to look a little deeper at how each of us are seeing the current environment today. Bill, as our banker, I'd love to tee it off with you. Give us a sense of if you're seeing note sales that are a part of most institutions' disposition plans for these problem loans currently in the current environment.
Sure. Well, clearly what we're seeing in the workout group of I'm sure every bank is just identifying to what extent the loan portfolio has been impacted. So when the stay-at-home orders first came out in mid-March, the first quarter was basically done. So you didn't quite see the covenant defaults and the issues then when the first quarterly statements and the covenant compliance certificates came out. You probably heard from customers during the early part that were having liquidity challenges, and especially from companies that their credit quality was impacted prior to the pandemic starting. And then as the quarter went on, it's become apparent that now we're starting to see the delivery of second quarter financials, and even customers that you may not have had an ongoing dialogue with, you're starting to see numbers come in with some surprises. And unfortunately, on the workout side, we are seeing some negative implications that we're having to deal with. And so, banks are having to identify their problem assets and put in place appropriate staffing. Note sales will become a part of the disposition strategy as it has become, clearly an accepted accelerated disposition tool for problem assets. The regulators encourage you to have a note sale function set up so that you can deal with these assets. Sometimes banks will want to reduce their NPL levels in an accelerated way because they're trying to meet either a quarter end goal or a ratio, some sort of management plan that they need to achieve. And also just in general, especially in the real estate space, they'll use note sales as an alternative to foreclosure. And then as we also examine our problem asset portfolios, we'll use it, note sales can be used to manage the portfolio concentration issues. If you've got too many loans secured by hospitality properties or restaurant properties, you may look at it as a tool to exit those particular segments or industries.
Thanks, Bill. So yes, it's definitely an ongoing process. With that, I want to let me turn back to Rick. Want your perspective as well as from the Family Office Consortium perspective. Do you think this is a good time for investors in this space?
Not yet. Because we think the implications of COVID and its effect, especially in the mortgage market, are not yet felt. So we did have some good portfolios before. We actually liquidated most of that before this, and somewhat still in the process of liquidating. But we don't think this is a short-term impact, so we're not quite yet willing to get back into the marketplace. We think there'll be opportunities, but we're, how would I say, more conservative in that respect. We like the non-performing mortgage side of the business when the manager, we always do it through a manager, is interested in rehabilitating the borrower. So we like that strategy from a number of perspectives, but we're just not ready to jump back in.
Yeah, agreed. Yanel, from your side, what's the state of the market for non-performing mortgages in our current environment? You got to mute out first.
So we've seen a lot of opportunities in the market so far. The problem is that there are not enough forced sellers, and like Bill said, I think that most of the banks and lenders are going to start selling towards the end of the year when they need to meet their regulatory requirements and also their lending requirements. So the transaction that we've seen and that we've done were for like smaller financial companies that had some margin calls and some like stress from their investor or from some other reason, and we were able to buy some of the loans. So we've seen both like large transaction going on, like $6-8 billion, but it went to like basically other large banks, and also like a lot of smaller transaction that happened. So we've been in the business a long time, so we have a lot of lenders who are calling us to sell us their loans. We've been able to buy like a decent amount, but I believe that we're going to see most of the inventory coming towards the end of the year. So in the meantime, we're getting ready. We're getting our processes ready to take advantage of that and hire more like law firms, hire more like servicers, and get all the lines of credit that we need to be able to buy more loans towards the end of the year. As far as the commercial side, we are not going to buy loans for the moment. We need to make sure that first we need to see where the valuation of the commercial properties are going. We don't know what will be the valuation of a hotel yet. We need to see some transaction happens before we can start like buying loans, and we expect to see a lot of those coming to the market. So we don't want to be catching a falling knife. When it comes to the residential, I think it's a great moment to buy non-performing residential loans because we have a shortage of like inventory in the country, and we're able to sell all our loans, our REOs pretty quickly. They stay on the market very few, even like in difficult market like New York right now, they just don't stay on the market long. So so yeah, that's about it.
No, I was going to say your point's right on terms of the commercial, the impact on valuations from COVID. It's still far from clear. Just to keep moving on, Michael, I wanted to have you touch a little bit on the opportunities that you're focused on across the private debt market right now.
Sure. Yeah, and I would echo what Rick and Yanel said. We also think to be buying loans, it's a bit early days here, but we're certainly gearing up for it. And then again, we're an asset-based lender, so we're both originating new loans and we're purchasing loans. Our background, again, coming out of Credit Suisse and specialty finance, I think we have the benefit of traveling in a lot of different sectors, and certainly think that's part of the advantage that we have in the space at the moment. So when we look around where we're seeing increased opportunities today, certainly can highlight a few of those. I'd start with maybe the receivables factoring space. You have an increasing number of small businesses and suppliers out there who are looking to borrow against receivables, looking for liquidity right now. Another sector that we're excited about is again, Yanel just hit on the residential market. We like the single family rental space. People continue to leave metropolitan areas with everything going on in COVID. We are funding actually right now an operator who's out there purchasing homes in some of the high growth areas outside the cities. So high growth areas, call it a $250,000 purchase of a house. You put a little bit of money in to fix it up, and then you're renting it out. So as a lender, we're secured by obviously the rental income, but the house itself as well. So we like that space. Within commercial real estate, we're certainly active there. Cautious on, certainly cautious on hotels, cautious on the office market, but things like self-storage, we have done a couple of deals that are working out very well in the self-storage space. One of our biggest loans was to an operator in Nashville. When the schools closed down in March, all the students threw their stuff in storage, and all of a sudden, it's been great. They're at full capacity, and I'd say industry-wide, I think that's been a pretty common theme. Away from that, autos, another space where we've been active. Certainly new car dealerships have been struggling, but the used car market has been hot, and we have certain financing arrangements in that space. So, there are definitely pockets of opportunity on the origination side. Consumer, we'll touch on it more, I'm sure, but we're certainly gearing up to be purchasing more charged off receivables there. I think it's early days, but we are in the process now. We've allocated some dollars, and we actually just are raising a co-investment now with a partner who is out there and very active in that space. So maybe lastly, the one other opportunity that we're seeing at the moment within commercial real estate, again, we are the owner of one of the 14 available non-bank SBA 7A licenses out there. So any FDIC chartered bank can be in that business. If you're not an FDIC chartered bank, there's only 14 licenses from the SBA that allow you to basically originate commercial real estate backed loans under their different programs. High barriers to entry, very attractive economics, and essentially partial guarantees from the government on those loans. In light of everything that's happening today with some of the COVID benefit programs and PPP, that's been an interesting space to be in, and obviously we're well positioned to be part of that. So similar to others, I think it's early days in some spaces, but certainly a lot of opportunity presenting itself right now, especially if you have the flexibility to kind of navigate across asset classes and go where the opportunity is.
Excellent. I appreciate that, Michael. So I guess I agree with everyone that's too soon. At our end with Oakshore, we're closely watching the regulation on restrictions on collections. But we've been really pleasantly pleased with liquidations through June, especially what we expected. The hits we were expecting back in February and March just haven't materialized. I think some part we buy very broadly and diversely across the U.S. markets, but I think it also touches we only buy consumer debt. It really touches that the consumer's credit facilities are increasingly becoming how Americans are making essential and staple purchases, and it's not just discretionary in the past when we thought that first focus would be on rent and mortgage. But yeah, we're not seeing we're waiting for the next shoe to drop. We have a great question from the audience. We were going to originally cover this later on in our prepared section, but let's dive right into it. A question from Daniel Hemster, and I think pretty much everyone can speak to it. How do you get access to the non-performing loans from the banks? Daniel, at our end, we're working directly and contracting directly with lenders that want to sell off their accounts. They bulk them, batch them up every month, and we get those 6 months called fresh charge-off. It's fairly, the contract process is not straightforward, but once all the terms are in place, it just goes on autopilot, which is part of why we like it. Let me open up the floor to Michael, Rick, Yanel, and Bill. You may have a perspective on the bank side as well. Anyone wants to jump in first, just hop on in. So again, the question is, how do you guys access non-performing loans from the banks? Yanel, do you want to take a crack?
Sure. So we, since we've been in the business for close to a decade, we receive opportunities from smaller brokers and smaller lenders that we know, and they know they know that we're just going to buy the loan pretty quickly without needing to market the loans. Like a bank or a lender never likes to market their loans because they don't want the market to know that they did a bad loan. So they're stuck having to sell it to one or two people without making a lot of marketing. Some banks or some lenders have to use larger institutional brokers such as DebtX or Mission Capital to sell their loans to show their investor that they got the best pricing for that. So depending on the size of the loan and the type of assets that you're looking for, I think you should speak with a specialized broker or those larger platforms.
Great. Michael or Rick, anything to add there?
Sure. It's Mike Ardisson here. So we approach it as a funder, right? So again, we're an asset-based lender, and what we do through our private credit funds is we typically find, I'll talk specifically about the consumer charge-off space, I guess, but we work with specialists and we provide funding. So what we've done in this space, as an example, is we've partnered with an operator who's been purchasing charged-off consumer receivables for 20 plus years. They put billions of dollars to work, and again, kind of consistent with our theme of our funds, the banks have pulled away from certainly lending in a business like this, right? So you've got a great team with a great track record, a lot of contacts and expertise in the space on who are the buyers they want to partner with, the collectors they want to partner with, what types of paper do they want to be buying here, whether it's credit cards, auto, the fintech peer-to-peer platforms. But we will work through them. So we actually fund them with 15% coupon debt, and then we share in the upside on the collections once we get paid our principal and our interest back. So, we try to structure these transactions where, in this case, we're working with experts in the space and specialists in the space. We provide them with debt capital. So, we're essentially getting front-ended cash flow. And then we give ourselves the ability to capture the upside on those collections on the back end. But really, we're trying to partner and fund good operators, folks who have been through market cycles, gray hair, and have been through this before. And then, in some cases, we'll partner there. Away from the consumer charge-off opportunity, yeah, certainly we're working with banks. We're working with just relationships of having been in specialty finance for 25 to 35 years, depending on who it is at our team. But it's really leveraging your expert network and relationships across the industry to get good looks at those pools. And similar to what Yanel said, we operate on the smaller side of the business, and we're doing deals that are typically 3 to 30 million in size, and tends to be a little bit less traffic, a little bit less competition, and tend to get some looks at pretty niche opportunities, which we like.
Great. Rick.
Yeah, we're not operators, we're family offices, so sometimes we're funding direct purchasers of charged off receivables. We're definitely on the smaller side of the business, but we also work through intermediaries, meaning people who fund. We loan them the money and then they fund it on. But being a family office, we're not involved in the direct process, obviously. We are sometimes concerned about liability because it's a business where there is liability under federal statute. So we do a lot of vetting of the manager.
But Daniel, just to sum up what we're hearing across the board, all of us, getting the direct deals and not dealing with the brokers is one of the key values that the folks are adding, and that's where we find the real value. On that note, I guess continuing on and turning to looking at the future, what are we looking for? Kind of effectively see the shoe drop. Where do we see opportunities coming? Bill, you kind of touched on this. If there's a little bit that you want to add on note sales being used from the early stages as to what are you going to see increasingly over time. We're running a little late, but I do want you to touch on that before I go to our other buyers. Bill is still with us.
Bill,
I apologize. I didn't unmute properly. Sorry about that. Just real quickly, I think we kind of agree with the investors is that it is early in the cycle and we're still in the identification and workout phase for our problem loan portfolios. I think as you see, hopefully when a recovery is in sight, I think you will start to see larger volumes of all types of loans being sold when bank earnings stabilize and the impact on loan loss reserves can be estimated. I think the banks will become more active sellers. Perhaps in the earlier phases, you might see some non-bank lenders out there to the extent that they may be having, liquidity or capital allocation issues that they may wish to be sellers on the front end. But I think for the most part, it's going to increase probably into next year once we hopefully begin to stabilize.
Yeah, agreed. Okay. Michael, next question for you, and then when you're done, if you look at the Q&A chat, there's a question if you could type out when Yanel and Rick are speaking. Michael, question to you, in what sectors do you see or are you expecting to see the best opportunities going forward?
Sure. Yeah. You know, again, we're fairly active across a number of different sectors. I think, you know, relevant for this panel, if we just stick with consumer charge-offs for a second, you know, that's an area where we've been funding a partner of ours for about a year now. And, you know, I think as we'd all probably agree that the view there is generally in periods of recession, the pricing environment obviously becomes a lot more favorable. The increase that you have in delinquencies and defaults and the bank's eagerness to sell those off at sharp discounts will just put pressure on pricing, and it's that much more attractive for buyers to come in. So again, from all of the sectors we look at, from real estate to auto and aircraft and consumer, you know, we like the consumer charge-off space. You've already started to see in parts of that market, particularly in some of the fintech platforms, you know, pricing has come down from February already 30 to 40% in certain parts. So other areas have hung in better. You know, credit cards, we haven't really seen the pricing come down much yet. But as I think we've all kind of agreed here, as some of that government subsidy money wears off and, you know, the euphoria of a lot of these benefit programs fades away, our expectation is over the next 6, 12, 18 months that it's really going to be an attractive time to step in and be buying those charged off consumer receivables. And we are gearing up and allocated additional funds that will deploy over the next 12 months into that space. Again, receivables factoring is definitely a space that we like right now. Again, just thinking about the liquidity constraints that a lot of businesses are facing. If they've got receivables coming in the future, a lot of folks are willing to sell those receivables at a discount. Again, we are funding operators in that space who will basically take advantage of that and are making good profits right now in the receivables factoring space. And then maybe lastly, when we're talking about distressed opportunities, we're active in the aircraft finance market. And as we all know, that's a space that's been decimated in the last 3 months, and the outlook there remains unclear. We operate in both the securitized form through aircraft securitizations, as well as in direct form where we are a lender to aircraft leasing companies who are essentially buying planes and leasing them out to carriers. So there's certainly a lot of opportunity there if you know what you're getting into and you find the right partners, find the right deals. You know, as planes inevitably start flying again, which, you know, it's such a ingrained part of the global economy and the global community. We think it's a matter of if, not when. When, not if, that you know, planes are flying and that business picks up again. So if you can position yourself conservatively with good operators, with good aircraft backing you, we think that's going to be an interesting opportunity over the next 12 months as well.
Excellent, thank you. Yanel, just to get a slight shift to something a little bit more to a niche, specific to deficiency judgments on the mortgage loans. Are you pursuing these after foreclosure, and do you believe you can collect on the entire amounts in the current economic climate, especially if things worsen?
So most of the time we pursue like deficiency judgments because we want to let the borrowers and the attorneys representing the borrowers know that we're not just going to give up if they start litigating. We want them to know that it's going to cost them way more money after that. And it's great. It's for our reputation. It's great because we have an easier time after that to settle cases and to get loan modifications. Some lenders just don't go after deficiencies because it's too expensive. And and borrowers know that, and they just drag foreclosure as long as they can. Some other lenders are selling those deficiencies just for that. So other specialty finance company go after them and make sure that borrowers are like modifying the loans. To collect the entire amounts is usually extremely difficult. We like to go after deficiencies when there is some type of real estate, when the borrower has other like real estate assets, and we go after those like pretty aggressively. When we feel like that the borrower is just going to file Chapter 7 and discharge the debt, we don't necessarily want to spend the money going after those, and we try to collect them. We try to settle them at like a lower amount.
Excellent. Thank you for that. So back to you, Rick. When we were speaking earlier, you were talking and sharing with me some of the concerns that the time wasn't right. I was hoping you can expand on this a little in terms of, are you looking for certain aspects of the pandemic to play out and the country's response, or are you looking for some capitulation in some areas? What are kind of your buy signals?
Well, there's a couple of things. One, the legal environment now is not good for foreclosure or any process around that. Courts, even the courts that are open to do that, are loath to do that, and it's a very slow process. So in some areas it's slower than others, obviously, depending on state law, but the entire process is going to be delayed dramatically. It's going to be very hard to get courts to even hear these cases. So I'm concerned about the remedy side of it for a long period of time. And so we did have, a couple guys who were doing non-performing loans in the mortgage arena, doing fine, buying good portfolios. Most of them were trying to do workouts with the underlying homeowner, getting their credit improved, and then refinancing. And that worked pretty well. I'm not sure if that strategy will work well in the future, because I don't know how this is all going to shake out and how the mortgage market is going to look going forward. Obviously, we're in a very long period of low rates. Maybe I'll die before rates go up. And so that is good overall for the housing market and for refinancing and for the mortgage market. But I'm very concerned about the legal side of these cases, that the traditional remedies and that, more importantly, the perception of the traditional remedies is just much less significant.
Exactly. Okay. No, thank you for that. We have a few questions. That looks like we've answered them. Rick, I know you're on a timeline. Is there anything? I just want to fast forward for you. Anything that we didn't cover earlier in terms of how you access these investments, or which spaces do you think most likely would be of interest to you in the near or longer term future?
I'm confident.
Keeping in mind the earlier comments we talked about, the concerns you have.
At some point, non-performing mortgages will come back into vogue and not be as risky as I perceive them now. The factoring side, we just pulled away from that because I have no idea what's happening in retail and restaurants going forward that we were factoring before. I don't know if restaurants are going to open again, if they're going to be 25% full or 50% full. We really closed out our entire book. We didn't make any money on it, but we pulled back completely. We didn't lose money, but we're concerned about what the new environment will be for those types of businesses. We were doing very small factoring in terms of the loan amounts, and a lot of that's not collectible now, in my opinion. So I'm on a look and wait, but I am not just concerned about the economic side of things. I'm concerned about the legal side of things. How has the legal environment changed due to COVID, due to the delay in hearings, due to the massive amount of backup there are on foreclosure activity in a lot of areas? That is an economic factor that I don't think people are carefully considering.
Agreed. Yeah, the longer we go, it seems that we have similar issues to the kind of the backups that occurred in the '08, even though there's a lot of differences between the '08 and today's. Thanks for that. If you can join us for some of the other panel questions, audience questions, great. Otherwise,
Antonio,
great
there's a question for Rick Stone to elaborate on what he means by his concerns.
What I mean is that in the areas where foreclosures were statutorily or by executive order not prohibited for a period of time, people filed papers but didn't actually foreclose. So there's a huge backup in the court system. And then secondly, courts are not in session. I mean, my hearings, to the extent we get them, are held by Skype or Zoom like this, and it's a much slower process. I don't see the courts fully opening up until post-Christmas next year. So the whole process of, pushing the thing through foreclosure or threatening to effectively to push it through foreclosure, which leads to settlement, is going to be delayed like 6 months or a year or more. And I don't predict the future, so I don't know when that will end. But the legal system is ground to a halt in terms of effective, enforcement of remedies or threats of enforcement of remedies. And at some point, that's going to start again, but that delay is going to delay people's rights. And I think, what we had in 2008, a lot of judges wouldn't issue foreclosure. They started coming up with these arguments about the documentation not being original, some of which, from a legal point of view, I'm a lawyer, considered nonsense. But courts were looking for reasons to screw over lenders, and I think we'll be back in that environment.
I think we've covered all the Q&A currently with the audience. Good. Okay. So with this last piece, coming back to touch a little bit more on accessing these deals, is there anything that you haven't covered already from our question from the audience, how you're sourcing the deals and direct sales from lenders, et cetera?
Sure. So like I said,
if you've covered it, if you've covered it, great. We can leave it open for the audience as well.
Sure. I'd just like to add something. We are working with about like 25 law firms like nationwide, and they represent a wide range of lenders. So those attorneys usually send us like a lot of like referrals, a lot of deals. So it's a great source of like referrals. I would say also there are ways to look at public records to see what are the lease pendants that are being filed, and we're doing that. So we know who has what, which bank has what, or which lender has what, and it's a great source for us to see what we can buy. Last thing, I think that you should people should speak with their mortgage brokers, because right now it's harder to originate loans, and those mortgage brokers are converting into non-performing mortgage brokers. So I think they're a great source of NPLs, and the people should speak with them.
Excellent. Thank you. A question from the audience. Bill, when do you think banks will start selling commercial loans impacted by the COVID shutdowns? I think you've kind of mentioned that it's going to be it's a slow process, 12 plus months out, but is there any additional color you can give for our Milan?
No, I think it will be a slow process, and I think it will be when you start to see signs of a recovery and the portfolios are stabilizing.
Agreed. Okay. And then a question from Marcelo. Is there any person buying loans today off of the marketplace? If no, why not? I think we've covered the why not part. But if anyone wants to chime in, and Rick, if you're still here, if there's anything at all that people are buying,
Yeah,
You wanna-
it's Mike Ardisson. I can chime in a bit on what
Great.
we're doing with our partner in the consumer charge-off space.
Excellent.
You know, some of the best discounts that they've seen so far have been in some of the peer-to-peer marketplaces. So, you know, I think the price where we've been buying with, again, through our partner where we fund, prices are down, you know, 4 or 5 cents on the dollar. So that pricing has come down sharply. And, you know, I think, again, we still hold a bit of a caution that it's early days and we know the wave is coming. But if we can dabble and be selective, particularly in some of the smaller pools from, again, some of the less trafficked sellers in these P2P platforms, we are certainly being opportunistic and putting some capital to work where we can get really, really attractive pricing. Again, kind of 4 or 5 cents on the dollar.
Yeah. And then Marcelo, I would say to us, we still are doing our monthly acquisitions of existing forward flows that we have under contract, but we're really being we're not seeing the lenders giving us the discounts we think are merited right now with all the uncertainty, and we're certainly not chomping at the bit to have buyer's remorse. We're really seeing, you know, the next 6, 12, 18, 24 months of acquisitions. They really will be fantastic, but it's just, it's timing. Timing is going to be everything. And we share a lot of the same concerns that Rick, Munell, and the rest of the panel have shared with you today. Anybody else, before I close out to Marcelo, anyone else that they're buying loans today that we haven't already covered? All right, so I think with that, we're still looking for other audience questions with the time we have left. But Bill, did we talk somewhat about what do you see institutions and banks doing to maximize the value when they choose to sell? And again, you heard it, we're kind of a tough audience in terms of, you know, banks don't want to take too big a haircut, but it's right now, a lot of us are on the sidelines. What do you want to give a crystal ball a little polish?
Well, I think in return of what can an institution do to maximize the value of the loans it chooses to sell, whether you're a bank that's selling or even an investment fund that's purchased a loan and then later on after it's been rehabilitated, whatever you want to exit, you know, it's a very simple answer that I found from being on the buy side for a number of years and from running the note sale program. It's really just, you know, deliver the most up-to-date information possible. Show that there's evidence of recent borrower contact, there's been active efforts, and just demonstrate what the collection strategy has been, even if it hasn't been successful, but just to show that someone has been in there involved with the credit. You know, get the recent financial statements, your site visit summaries, updated appraisals, and as a seller, you know, run an established process. Decide what you want to sell, set a reasonable timeline for the sale process, have your due diligence materials ready at the beginning, and keep the information flowing to the investors. You know, answer the questions as best you can, and keep the portfolio stable. Don't have 20 loans at the beginning and start pulling things out as you go along. You know, investors, I found, will pay you for what information can be verified, and I think that's what a seller can do to maximize its value, is just simply provide the best and most recent information possible and put an effort into selling the loans. It is not difficult. It is not easy to sell a loan. It's easy to lose value if you don't do it properly.
That is a great word of caution. And actually, Bill, follow up from RMLM. Due to significant changes in the market over the first half of 2020, I think we've kind of already covered this, but how long do you think it'll take for the bid-ask spread to close?
Well, it's hard for me to answer that. I mean, we're not an active seller in the market, so I'm not seeing what pricing is coming back on assets we are trying to sell. So it's really difficult for me to answer that.
Yeah. Anyone else want to talk about the gaps that they're seeing between the buyers and sellers, the effective bid-ask spread?
Yeah, I think it's Mike Ardisson again. I could say from Medalist standpoint, you know, you look at loans, whether it's aircraft or commercial real estate, it's been pretty wide. And I don't know that changes. I think we're all probably in agreement here again on this, but until you get more fundamental data out there on, you know, who's paying, what's the cash flow expectations, where you're seeing asset sales, it just strikes us as hard to imagine that you're going to really see clarity on that until, you know, at best, probably 6 to 12 months. And, you know, it certainly seems to be early days. So we wouldn't expect too much clarity there anytime soon. You've really got to get a grip on fundamentals and where everything's going, and, you know, where the vaccine and, you know, is there another surge? There's so many unanswered questions that I think you're, as everyone said, you're better off being cautious rather than having buyer's remorse at some point later.
Great.
Antonio, we have a question from Andrea Liu at Liu Family Office.
Great.
I believe
Send it.
she wants to talk.
I don't see it, but if you have it, go ahead and speak it out.
Andrea, can you hear us?
Yeah, I can, but did I have a question? I mean, I always do, but this is super interesting. But I do have a quick question now that we're on it. I'm interested in knowing are you able to hear me?
We can hear you, yes.
Oh, okay, sorry.
Yeah.
Just, so are you seeing tranches of NPLs come through then? Is that, and are you seeing anything with super priority liens? I know you guys do a lot of lending against, but just wondering if you guys are seeing.
Anybody on the panel that can talk to that? It's that both the tranches and the super priority liens are kind of outside of my current scope.
Yeah,
Sure,
especially when, oh, sure, sorry about that. Go ahead.
No, go ahead.
Yeah, it's just from the last time this sort of happened en masse, you know, a lot of these would go through Goldman first, and then whatever they wanted, they would keep. But then, you know, then they kind of passed it on. Do you see this kind of repeat both on the commercial as well as the residential on those levels? Is that the expectation?
So this is Leonardo Vico. Yes, we've seen a bunch of larger transactions that banks have been purchasing in the non-QM, the bridge loan, and on the first and second mortgages. They got some portfolio of like specialty finance like lenders, and they are trying to sell them at the moment. So we receive calls from those lenders, and they try to sell those smaller pools that they need to sell. And as far as the super priority lien, can you elaborate the question?
Andrea, can you hear us?
Oh yeah, sorry. I don't know why I went on mute again. Yeah, so where did I get cut off? Okay, so I started to say in some 20 plus jurisdictions in the US, condos have the statutory right to foreclose on back payments of condo fees that become constructive liens placed against some of these condo units. So it was in full force for a while, but I think banks started to pay those off. So HOA foreclosures started to become a thing of the past, but I think they, well, you know, I don't know if it's still, you know, as relevant as just, you know, regular mortgages, but in case someone. Mm-hmm.
Yeah, so we purchased like a various amount of mortgages in those states such as like Nevada or Florida.
That's right.
And today the law just changed and is protecting the lenders, because in Nevada, like an HOA could like wipe out the first mortgage, and it's not anymore the case. It's not anymore the case. In Florida, they changed the law, and an HOA is entitled to a maximum of 12 months of the monthly dues, or 1% of the amount of the mortgage. So there's not much more risk with like those super priority liens, but it's better to like watch them, obviously.
Okay, thank you.
Yeah, the other thing that'll be interesting this time around is, the last financial crisis, from our seat, we were at Credit Suisse, and I think we had a front row seat to how this played out. We had a much larger balance sheet, or all the banks at that time had much larger balance sheets. What you've seen over the last decade from regulations and limitations on what the banks can hold on balance sheet, it'll be interesting to watch this time how that plays out, right? So we had a $50 billion lending book at Credit Suisse when we were running the asset finance business. When we left after the financial crisis, that $50 billion was down to $4 or $5 billion. So what they're holding now at the banks, I think they're much more in broker mode of, maybe they'll buy some loans and they'll turn around and flip them. I don't think they have the appetite to hold as much as they did. What's different around this time is you have all these non-bank lenders, including ourselves and a lot of others who have, kind of stepped in to fill that void a bit, who may be able to be a little bit more flexible on capital. So, just to your question, I think it'll be different this time around. There may be different players doing it, and we'll have to see how they innovate and, the areas of the world as well. Where do they fit into this? We shall see. But they've obviously everybody's been raising a lot of dry powder to step in with the expectation of distressed asset sales coming. And it'll be interesting to see if they've got the right expertise in-house. A lot of these guys are middle market corporate lending firms that now want to get into the distress space. And do they actually have that expertise? Have they been through the cycle to know how to work these loans out and what you do when you buy them? I think there's some questions there. So you want to be thoughtful about, who are you partnering with when you're trying to get capital and buy these loans. You may end up with a lot of people who end up buying it and then don't know how to work these things out once they have them. So it'll be interesting days ahead for sure.
Yeah, cool. Thank you.
Mike, I think we're over, and I think we've answered everyone's questions, unless you have anything else at your end.
No, that was perfect.
Okay.
That was.
I was going to say
perfect.
it may not be what the Invest Today crowd wanted to hear, but it's I think the consistent message is yes, there's going to be a lot of opportunity, but it's not today.
Okay, Antonio, is that the conclusion of your panel, or is there any closing remarks that you want to take?
No, I think the if I would tie up everything that we're hearing that we've said, I think what we all have in common, we're all in different spaces, but I think what we all have in common is all of us are going to be at our busiest, including Bill, in terms of he's not on the buy side or the investment side, but we will be at our busiest during times of crisis, and even and some of the greatest opportunities happen in these times of crisis. But the timing is everything. And so it's the thing I kept hearing is that we're being very careful, tighter with any acquisitions we're doing now, investments we're making now, but really it's preparing, keeping the dry powder, getting the third parties in place. So then when some of the uncertainties clear up, some of the capitulation happens, you can really move in fully. And hey, thanks again for having us, Mike.
Bill, Rick, Michael, Antonio, thank you very much for a strong finish. And I am going to turn this over to Rainford for a closing.
Thank you, Michael. Good afternoon, everyone. Thank you for joining us today for Flyers Real Estate Direct Lending and Private Debt Forum, Part 5. We've had 2 days of fantastic insight from our panelists. Don't forget that our Part 6 event will be on September 10th. That is going to be a one-day event at this time. We'd like to thank our sponsors, Nationwide, Allagash Partners, Preqin, Boomerang Capital, S&P Global Market Intelligence, Safe Harbor Equity, the Mortgage Office, Harvest Volatility Management, Millennium Trust, Apex One Investment Partners, Intrust Global, Off-Chain Capital, and Clarion Asset Management. We'd also like to thank our panelists today for providing their expertise and commentary. It was a fantastic day of insight from our experts. We hope you've enjoyed the event, our two-day event here, and thank you for attending and have a great day.